Okay.
我坐呢邊啊。
Hi, good morning, everyone. Haven't seen you guys for quite some time. Well, good morning. Welcome to Morning Kappa. Here we come to the week 4 of June with futures. Before we begin, I'd like to highlight on some disclaimer. Okay, trading in futures and options involve a high level of risk due to leverage and may not be suitable for all investors. This presentation is intended for educational and informational purpose only, and does not consist of any recommendation to buy or sell any financial instrument. Please consult your licensed broker or financial advisor before making any trading decision. Let's start. The global market has undergone a significant shift in dynamics. The intense war premium that previously gripped in
For issue, your screen sharing not running. I think internet issue.
sorry, let's continue. Okay, the global market has undergone a significant shift in dynamics. The intense war premium that previously gripped investors has suddenly dissipated following the United States announcement of an impending diplomatic breakthrough with Iran. The easing of Middle Eastern tension has removed fears over crude oil and agriculture supply disruption, triggering a broad wave of capital reallocation across the global markets. For local products, FKI shifted from positive profile to a neutral stand. Crude palm oil moved from a positive profile in week 3 to a neutral stand in week 4. In Asia, the Hang Seng Index recovered from a sharp negative shock to stabilize at neutral. Regional markets are taking a defensive breather as foreign capital flow rotate heavily back into major global technology. Meanwhile, the China A50 remained locked in a short-term neutral holding pattern for consecutive weeks. In the US market, the Dow Jones, S&P, Nasdaq, and Nikkei 225 remain the clear powerhouses, holding a fully positive profile across both weeks, supported by a historic technology capex boom and blockbuster events such as SpaceX IPO. These indices continue to shrug off inflation concern and push to a fresh all-time highs. In the grain complex, corn, soybean, and soybean oil, markets were hammered into negative profile as supply chain panic subsided. Therefore, this contract stabilized into neutral. For metal, gold shift from a neutral to negative. Despite maintaining a long-term positive trend, silver and copper both move into a neutral profile during week 4. Crude oil transitioned into neutral stand this week, while its long-term overall trend remained positive due to months of structural blockades. The immediate panic has now fully deflated, while natural gas remained neutral this week. Okay, currently the US dollar is holding firm near the 1-year high reached late last week. So gold is under our radar, making gold less affordable for buyers using other currencies. The United States has waived sanctions on Iran for 16 days starting Monday. However, the first talk under an emerging peace deal. Officials also reported a sustained pause in fighting the Lebanons under the agreement aimed at ending hostility across the region. The chart displays a significant macro bullish run that started mid last year, accelerating sharply in late 2025 to early 2026, where it stopped out at an all-time high of 5626. Since hitting that peak, the market has structured into a clear bearish markdown phase, characterized by lower lows and lower highs. At present, gold is attempting to break below 4,100 after being rejected at the resistance level of 4430. The next support level to monitor are USD 3935 or 3359. Okay, WTI crude oil futures recently fell below USD 73 per barrel on Tuesday, extending losses from the previous session to reach a near 3-month low amid signs of initial progress in ongoing US-Iran peace negotiations. In a key development, Washington granted Iran 60 days license to sell oil on the international market, raising expectation of quicker recovery in global supply. Traffic through the Strait of Hormuz has also picked up, with producers such as Kuwait and the UAE finding alternative export routes, while Iran shipped more than 30 million barrels over the past week. As a result, prices are currently hovering near the key support around USD 72. If this level is breached, the next support is at 65. Before we look ahead, let's audit last 2 weeks. We had one call with realized profit and one void call. Natural gas achieved our potential profit price with realized gain of 240. Whereas the second call was soybean. The price has reached our potential profit price without triggering the reference price. Therefore, the call is void. Okay, as usual, the highlight of our briefing, the future market call. Building on last week's momentum, we are anticipating a potential opportunity in soybean oil. The initial investment is USD 2,310. Short-term chart setup is positive, and reference price is 66.3. While potential profit is 68.5, targeting a gain of 1,320, and potential loss price at 65.3, capping potential loss at 600. So the risk and reward ratio for this trade, this call is 1:2. Whereas the second call for the week is micro copper. The initial investment is USD 1,320. The initial investment is 1,320. And short-term chart setup is positive. Reference price is 6.11. Potential profit price is 7 or 7.6, targeting a gain of 2,225 and 3,725. Potential stop loss is below 5.8, capping the potential loss at 775. So the risk and reward ratio to this trade is near 1:3 to 5 times. So if let's like what you have seen so far, there's truly no better time to get started. We have just rolled out a brand new client exclusive initiative called AMPM Market Guide, designed to help you navigate CPO intraday move with precision. Well, if you're completely new to the futures market, we have also got you covered with our TWP 2.0 campaign, which give you up to 500 in zero brokerage trading to help you start your journey. Ready to dive in? Get in touch with us and drop us an inquiry on RHB Invest website today. And of course, every trade you place will automatically qualify you for trade and win lucky draw entries, giving you chances to win a Tesla or take away the monthly prices iPhone 17. If you are from JB, we are delighted to invite you to our exclusive physical event entitled Futures Insight on 18 July 2026 in Johor Bahru Holiday Inn, where three special guest speakers, David Liew from CME, Joseph from RHB Head of Retail Research, and myself will share insights on market trend, trading opportunity, and strategy to help you navigate today's dynamic environment. Don't miss out. That's all from me today. Thank you for your time, and I'll hand over to the next speaker. Thank you.
Right. Thank you, Megan, on the weekly futures update. So looking at the market right now, the trend is very clear that Hang Seng's continue to move lower. Yesterday, it have breached the support of 23,500 point level, and right now the bear is still in control of the Hang Seng index. So we keep a bearish bias on the Hang Seng index. Meanwhile, there are two counters they are bucking the trend. Firstly, the Standard Chartered 2888 that have managed to climb above 215 Hong Kong dollar. The next one will be 225 and followed by 235, and down support is 205. So apart from Standard Chartered, Monday we also have mentioned about the HSBC stock code number 5. You can refer to the Monday report. Then on another auto counters, which is Geely Automobile, have also bounced off 175. So Geely have went through a series of corrections and right now managed to find support at 17 Hong Kong dollar. A breakout above 18 should open door towards 19 and followed by 20. And looking at the China A50, right, the index is undergoing corrections as of yesterday, right? And most of the counters are experiencing a profit taking after moving up for almost 1 week. And as of now, we see another opportunities on these China A shares, stock code 300604, Hangzhou Changchuan Technology. The counter have managed to climb above 260 renminbi, heading towards 300 and 340, and downside support is 235 renminbi. So looking at this Chinese stocks, despite that yesterday, majority of stock experiencing profit taking, it managed to hold up its bullish trajectory. So as long as stay above 235, upside momentum should continue. Now, meanwhile, I think the oil is not the focus right now. What the market is actually looking at is actually the interest rate, as we all have heard what the Fed is saying, right? And so the oil price is actually moving downward, like what Megan have mentioned. But the market have not decided yet what's the what will be the interest rate this year. Likelihood is not going to cut the interest rate, but there's a possibility that the interest rate is moving up. Hence, that actually have negative sentiment on the growth stocks. As you can see that yesterday in the US market, most of the high growth, high PE tech stocks are experiencing corrections. As we mentioned yesterday, right, those US company that spend money on the AI infrastructure capex, right, they have a very strong selling pressure. As of yesterday night, you can see that the Micron SNDK also started actually moving pullback yesterday. Now, in this environment, I think one clear theme is that the oil price is actually moving down. That will actually be a positive booster for the airline counters. So looking at the UAL, United Airlines, share price continue to stay above 120 US dollar. So next R1 will be 128 and followed by 136. Downside support is 112. Secondly, looking at the defensive counter, which is more not impacted by this cyclical movement, CVS Health also climb above $100. So next hour will be 105 and followed by 110, and downside support is 95. So we have one airline stocks in the US and one healthcare stock, which is a CVS Health in the US. Now, meanwhile, Malaysia market also facing a selling pressure, tandem with the regional market. FKRI went below 1,007. A strong support should emerge at 1650, right? We set our stop loss at 1650 and we continue to stay on bullish bias on the FKRI. As we mentioned yesterday, right, one of the key events that will move market sentiment will be this coming Saturday. They are naming candidates for the Johor state elections, right? Let's see how that will impact the market on next week. But I think this week, likelihood the FKRI will be moving between 1,007 and 1650. And then on for the FCPO, right, it has been creeping higher, testing the 4,007 resistance right now. Breakout will open door towards 4840, but failure to break past the 4007 may see a resumption of the downward movement towards 4005. So we keep a bearish bias on FCPO until a bullish breakout on the 4007. And as for market yesterday, right, you can see that some of the plantations counter, such as ILI and KLK, keeping their uptrend intact. Also in tandem, tracking the CPO price. Apart from the plantations counter, right, some of the more defensive counter are experiencing a bit of rebound yesterday, but the rest of the counters are mostly facing a strong selling pressure, especially the tech stocks, tracking the weaker performance in the US market yesterday. So looking at this morning in Malaysia, so firstly, I look at the UUE. What I see is that the strong volume have emerged. UUE have break past 43-cent resistance. Next hour will be 46 and followed by 49 cents, and downside support is 39 cent half. Now, secondly, YBS International is undergoing consolidations. Strong volume have emerged yesterday. A breakout from 29 cent half. We open door towards 32 and 34 cents. Downside support is 26 cents and half. So we have one breakout stock, UUE, and followed by a pending breakout YBS. So I stop here and pass on the sessions to John on the transportation sector update. Thank you.
Hi, morning everyone. Thank you, Joseph. Let me continue with our transport first quarter results wrap. Westport and FM Global reported in-line results, while Tasco full year numbers came in below our expectations due to a lower than expected contribution from the core chain business following the exit of its F&B customer. Looking ahead, the easing of the Middle East conflict should help to stabilize the oil and the bunker fuel prices, reducing the operating costs for Westports. And on top of that, Westport's fuel consumption is expected to ease by another 10% in the fourth quarter, following the deployment of 60 EV trucks by third quarter. And also the congestion issue back in early of January this year have been fully resolved, with the April volume rising 3% year-on-year and the yard density remaining at a healthy level of 70 to 80%. We therefore maintain our volume growth forecast of 4.5% year-on-year, which is still within management unchanged guidance of a low single-digit growth this year. All in, we maintain our overweight call on the sector, in line with our buy call on the sector heavyweight. Westport remains our sector top pick, and we continue to like the stock given the sequential tariff rate hikes, which are more than enough to offset the higher food costs and also the resilient volume growth backed by their intra-Asia trade flows. Hence, we recommend that investors can accumulate a weakness as we believe the conflict risks have largely been priced in. At this juncture, Westport is trading at their 5-year average PE of 16 times, and we continue to see upside potential should the government to establish the fuel cost pass-through mechanism, even though the timeline for this remains unclear for now. That's all from me. Thank you for listening. Happy trading and see you again tomorrow at Morning Kappa at